So good morning, everybody. This is a review for Chapter 5. We already did 1, 2, 3, and 4. So I just want to go over these 30 or so slides here, 33 to be exact. And this is about evaluating operating and financial performance. So basically, we're going to look at different leverage ratios and financial ratios. A lot of this you've probably seen previously in other coursework at Stony Brook. All right, so again, we look at these stages, and this is repetitive as far as the different stages go, right? And here's the life cycle stage. And there's different ways of looking at these ratios. As we said, there's the trend analysis, and the ratios are just simple division, and we could look at them in a cross-sectional way and compare performance against another company at the same point in time, right? That would be like Walmart comparing against Amazon.com. And you could also compare yourself against the industry as a whole, right? The average performance in your industry. All right, so here's an income statement, and we went over this in pretty much detail for 2 years. And you notice net sales is on top, right? Net sales is up on the top. And you subtract off the cost of goods sold and get the gross profit margin here. And we work our way down, and then the net income. Here's EBIT, right? Don't forget what EBIT is. And here is net income. And here's a balance sheet, and this usually they show it with the assets on the left and the liabilities on the right, but they have it all under one column here. So the liabilities and stockholders' equity starts here, and that should be usually on the right-hand side. So you'll notice the cash and the short-term stuff for assets and the short-term payments you have to make on your bills and everything are up here. So this is the short-term stuff. And here's a cash flow statement. The third statement is a cash flow statement. And you'll notice there's cash flow from 3 areas: operations, investing, and from financing. So that makes up the 3 components. And you should just know that makes up the 3 components of a cash flow statement. We're not going to repeat the work from 330. You kind of should know just how many components there are on a cash flow statement. All right, cash burn. You should know that term, right? It's the cash that's expended on its operating and financial expenses. And basically, the cash burn rate is simply the cash burn divided by typically 12 months out of the year, right? You get a monthly rate. All right, so here's the big long equation for cash burn. And you should definitely write this equation down on your sheet here, right? So that's there, and basically they do an example here, and we went over these numbers, right? We went over those numbers pretty carefully in class, and the easier one is the cash build, right? Cash build is net sales minus your change in accounts receivable, and what we got to do is highlight that in red, right? And so this is a real simple, and this is definitely important. You should know that, right? That's real simple, right? Notice how it's the change in accounts receivable from 1 year to the next, right? So just make a note, it's the change. All right, here's the liquidity ratios, and the current ratio, you've seen this in 330. So a lot of these ratios you've seen, and they just, you go over these carefully, and you'll see that, follow the numbers. You notice how they take an average here. They use the word average, and they divide by 2. And the quick ratio, again, everything's divided by 2. And what I should do is fix these, right? And let me go back here. Put a line here, right? Because, like that, let's fix those once and for all. and I want to make that thicker if I can. All right, we'll do that later. We'll make it thicker later. But anyways, average current assets minus average inventories over average current liabilities, and you notice they divide everything by 2 here. And remember, net working capital. This is an important thing to know. Here is it's just current assets minus the current liabilities, so you should know that, right? And you could take net working capital and make a ratio, divide that by total assets, right? And again, there should be a line here. All right, so and here's just a list of all the ratios with burn rates and everything. So, all right, and we move on to the leverage ratios now. And that's your ability to pay your debt, right? The extent to which the venture is in debt and your ability to pay it, right, the debt. So you have total debt to total asset ratio. You just take these numbers off of the balance sheet, right? Debt and total assets both come off the balance sheet. And again, you can see they're always dividing by 2 because they're always taking an average of 2 years. Equity multiplier, same thing. And current liabilities to total debt. You'll notice for the interest coverage ratio, there's a mistake in the book here. This is a mistake, and I'm going to fix it now. This divided by 2 should be taken out. One of your students caught that, and I'm very pleased to see that he was reading the slides and he caught that. So it really should be 40. If you follow your textbook, it should match. It should be 47,000 plus 17,000 all over 20,000. And it comes out to 3.2 times. This I said we're not going to cover, so don't worry about that. And now we get to the profitability ratios. This is important, right? And this is your gross profit margin. And here's your operating profit margin, EBIT over net sales. Right? And then we have net profit margin, which is net profit over net sales. And you should be able to find these numbers in the book and make sure you understand where they come from. Okay, so now we have basically the interest tax shield. And this is NOPAT, the NOPAT margin. And this is simply this equation here. Just another ratio. And all you got to do is get EBIT and your tax rate and divide it by net sales, which is what they do here. And we basically have sales to total assets ratio. Okay, return on assets. You're not going to be tested on these too much. Maybe a 1 or 2, but I wouldn't go crazy worrying about every ratio. That was 330. So here's return on equity. And here's the table of the profitability ratios. And here's all the ratios shown together. All right, so that's basically it for the review. And I'll post this one also.